Well, I've been thinking a lot lately about dividends. I know that might sound strange coming from me. People always say, Warren doesn't care about dividends, Berkshire doesn't pay a dividend, and that's true, we don't, never have. But that doesn't mean I don't appreciate a good dividend-paying stock, because I do. I really do. See, Berkshire owns a lot of companies that pay us dividends. Coca-Cola sends us over $700 million in dividends every year. Bank of America, before we sold some of our position, was sending us close to $1 billion. Those dividend checks, they just keep coming, year after year after year. Whether the stock market is up or down, whether the economy is good or bad, they just keep coming. And that's a beautiful thing. So today I want to talk to you about dividend stocks, specifically 5 dividend stocks that I think you could buy today and hold forever. Well, maybe not literally forever, but you know what I mean. Stocks that pay you reliable dividends. Stocks with strong businesses. Stocks that aren't going anywhere. The kind of stocks where you can buy them, collect the dividends, and sleep well at night, knowing your money is working for you. So settle in, get comfortable, and let me share with you 5 dividend stocks that have served me and Berkshire very well over the years. Why dividends matter more than people think. Now, before I get into the specific stocks, let me tell you why dividends matter. Because a lot of young investors today, they don't care about dividends. They want growth stocks. They want stocks that'll double or triple in a year. And I get it, growth is exciting. But dividends are dependable. See, when a company pays you a dividend, they're giving you real money, cash, not promises, not potential, real dollars that show up in your account. And that cash, you can reinvest it, buy more shares, or you can spend it, use it to pay your bills, whatever you want. But the point is, it's yours, it's real. Now, some people say, but Warren, if a company pays a dividend, that's money they're not reinvesting in the business. That's money they're not using to grow. And sometimes that's true. Sometimes a company should keep the cash and reinvest it. But a lot of companies, especially mature, stable companies, they generate more cash than they can intelligently reinvest. So what are they supposed to do with it? Let it pile up in a bank account earning nothing? No, they should return it to shareholders, either through dividends or share buybacks. And dividends, they're a sign of discipline, a sign that management is thinking about shareholders, that they're not just hoarding cash or wasting it on bad acquisitions. So when I see a company that's been paying and growing its dividend for 25, 50, even 60 years, that tells me something. It tells me the business is solid, the management is shareholder friendly, and the company has staying power. That's why dividends matter. That's why, some of the best long-term investments you can make are dividend-paying stocks. Stock 1, Coca-Cola Well. I have to start with Coca-Cola. I mean, how could I not? I've been a shareholder of Coca-Cola since 1988. That's over 35 years now, and it's been one of the best investments I ever made. Not because the stock has gone up 100 times, though it has done very well, but because every year, like clockwork, Coca-Cola sends us a dividend check, and that dividend has grown every single year. For over 60 consecutive years, Coca-Cola has increased its dividend. 60 years. Think about that. Through wars, recessions, pandemics, through everything, Coca-Cola kept paying and growing its dividend. That's the kind of business I love. Now, what makes Coca-Cola such a great dividend stock? Well, first, it's a simple business. They make beverages, sell them all over the world, and people love them. I drink 5 Cokes a day, have for decades, and I'm not alone. Billions of people around the world drink Coca-Cola products. See, Coca-Cola isn't just Coke. They've got Sprite, Fanta, Dasani water, Minute Maid, all kinds of brands. And here's the thing about Coca-Cola. They have incredible pricing power. When their costs go up, sugar, aluminum, labor, what do? They raise prices. And people keep buying because, well, if you love Coke, you love Coke. You're not going to switch to some generic cola just to save 10 cents. That's a moat. That's competitive advantage. And because of that moat, Coca-Cola generates enormous cash flow, billions and billions of dollars every year. And since they can't reinvest all of it, they're not building 10,000 new bottling plants, they return a lot of it to shareholders through dividends. Now, Coca-Cola's dividend yield isn't huge. It's around 3% right now. But remember, it grows every year. So if you bought Coca-Cola 20 years ago, your yield on your original investment is much higher than 3%. It might be 10%, 15%, even more. That's the power of dividend growth. That's why you hold a stock like Coca-Cola forever, because over time, that dividend keeps growing and growing and growing. So that's stock number one, Coca-Cola, a classic, a stalwart, a forever stock. Stock two, Johnson & Johnson. All right, stock number two is Johnson & Johnson. Now, I'll be honest, Berkshire doesn't own a huge position in J&J, but we've owned it on and off over the years, and I've always admired the company. Johnson & Johnson is another dividend aristocrat. They've increased their dividend for, I think it's over 60 years now, maybe more, and that tells you something about the quality of the business. See, J&J is diversified. They're in pharmaceuticals, medical devices, and consumer health products, Band-Aids, Tylenol, baby powder, all that stuff. And the beauty of that diversification is, when one segment is struggling, another one is doing well. If prescription drug sales are slow, maybe medical device sales are strong, or consumer products are picking up the slack. That's stability. That's what allows them to pay a reliable dividend year after year after year. Now, J&J has had some controversies, lawsuits, product recalls, all that. And that's something to be aware of. But overall, they've managed through it. They've got strong cash flow, they've got a diverse business, and they've got a long history of taking care of shareholders. Their dividend yield right now is around 3%, not spectacular, but solid, reliable, and like Coca-Cola, that dividend grows every year. So over time, your yield on cost keeps increasing. That's the beauty of these dividend growers. You're not just getting 3% today, you're getting 3% this year, maybe 3.5% next year, 4% the year after, and 20 years from now. You're collecting 8%, 10%, 12% on your original investment. That's compounding. That's the snowball rolling downhill. So stock number two, Johnson & Johnson, a diversified healthcare giant with a rock-solid dividend. Stock three, Procter & Gamble now. Stock number three is Procter & Gamble. P&G is another one of those companies that just keeps going year after year. They make consumer staples, things people need no matter what. Tide detergent, Crest toothpaste, Pampers diapers, Gillette razors. When the economy is bad, people still need to brush their teeth. They still need to wash their clothes. They still need all that stuff. So P&G's revenue is very stable, very predictable. And because of that stability, they can pay a reliable dividend, and they've been doing it for a long time. P&G has increased its dividend for over 60 consecutive years. 60 years. That's remarkable. That's longer than most people's entire careers. See, P&G isn't a flashy business. They're not developing the next iPhone or curing cancer. They're making soap and toothpaste. But that's exactly why they're such a great dividend stock, because boring is reliable, boring is predictable, boring pays the bills. Now, P&G's yield is around 2.5%. Not as high as some other dividend stocks, but it grows. And P&G has incredible brands, brands that people trust, brands that have been around for 50, 75, 100 years. That brand power, that's their moat. That's what allows them to charge premium prices and maintain margins. And because they maintain margins, they generate strong cash flow. And they return that cash to shareholders through dividends and buybacks. So if you're looking for a stock you can buy and hold forever, P&G is a great choice, because people are always going to need soap, they're always going to need toothpaste, They're always going to need diapers. And P&G is going to keep supplying those products, generating cash and paying dividends. That's stock number 3, Procter & Gamble, the king of consumer staples. Stock 4, Chevron. All right. Stock number 4 is a little different. It's Chevron. Now, I know what you're thinking. Warren, oil? Really? Isn't that a dying industry? And I hear that a lot. People say oil is dead. We're moving to electric vehicles, renewable energy, all that. And maybe, eventually, but not anytime soon. See, the world still runs on oil. Planes need jet fuel. Ships need diesel. Trucks need gasoline. Factories need oil to make plastics and chemicals. But Chevron is well managed, they've got low costs, they've got strong assets, and they're disciplined about returning cash to shareholders. When oil prices spiked in recent years, a lot of oil companies went crazy, started drilling everywhere, spending like crazy, taking on debt. Not Chevron. They were disciplined. They paid down debt, they increased dividends, they bought back shares. That's the kind of management I like to see. Now, I'm not saying Chevron is going to be around forever. The energy landscape is changing. But for the next 10, 20, maybe even 30 years, I think Chevron is going to keep generating cash and paying dividends. And if you're collecting a 4% yield and that dividend grows even modestly, that's a pretty good return. So stock number 4, Chevron, a traditional energy giant with a strong dividend. Not flashy, but dependable. Stock 5, Visa, and finally, stock number 5, Visa. Now, Visa is a little different from the other 4 because, well, its yield isn't as high. It's around 0.7% or so right now. But hear me out, because Visa is a special business. See, Visa doesn't lend money. They're not a bank. They don't take credit risk. What they do is they run the network. They process transactions. Every time you swipe your Visa card, Visa takes a tiny cut, a fraction of a percent, but it adds up because there are billions and billions of transactions every single day. And the beautiful thing about Visa's business is it's almost pure profit. They don't have to build factories. They don't have to hold inventory. They don't have to do much of anything except run the network. And that network just prints money. Visa has operating margins of over 60%. 60%. That's extraordinary. And because they generate so much cash, they can return a lot of it to shareholders. Not just through dividends, but also through buybacks. Now, like I said, the dividend yield isn't huge, but the dividend grows fast. Much faster than Coca-Cola or J&J or P&G, because Visa's business is growing fast. More and more of the world is moving to digital payments, moving away from cash. And every time that happens, Visa benefits. So even though the yield is low today, in 10, 15, 20 years, your yield on cost could be very high. Plus, the stock itself has a lot of room to grow because the business is growing. That's the trade-off with Visa, lower yield today, but higher growth potential. And for a dividend portfolio, I think it's good to have a mix. Have some high yielders like Chevron and have some growers like Visa because they balance each other out. They give you income today and growth for tomorrow. So stock number 5, Visa. A lower yield, but a phenomenal business with a growing dividend. The power of holding forever. Now, let me talk about why I said you should hold these stocks forever. Because that's not just a catchy phrase, I really mean it. See, the biggest mistake I see investors make is they buy a good stock, it goes up a little, and then they sell it. They think, oh, I made 20%, time to take profits. But what they don't realize is they just sold a great business, a business that would have kept growing, kept paying dividends, kept compounding. And yeah, maybe they made 20%, but if they'd held it for 20 years, they might have made 500% or 1,000%. That's the power of compounding, the power of time. I bought Coca-Cola in 1988, and people have asked me over the years, Warren, why don't you sell Coca-Cola? It's not growing as fast as it used to. Well, because I don't need to sell it. Coca-Cola still generates cash, still pays me dividends, still has a great business. Why would I sell that? To buy something else that I'm not as sure about? See, when you own a great business, the default should be to hold it forever, or as close to forever as possible. You only sell if the business fundamentally changes, if the moat disappears, if management screws up. But if the business is still strong, if the dividend is still growing, if everything is still working, just hold it, let it compound, let the dividends reinvest, let time do its work. Because time is the friend of a good business and the enemy of a mediocre one. And all 5 of these stocks, Coca-Cola, J&J, P&G, Chevron, Visa, they're good businesses, great businesses even. So buy them, hold them, collect the dividends, and let time do the rest. That's the strategy, simple but powerful. Reinvesting your dividends. Now, one more thing I want to mention, and that's reinvesting dividends. See, when you get a dividend payment, you've got 2 choices. You can spend it, or you can reinvest it. If you're retired and you need the income, sure, spend it. That's what it's there for. But if you don't need the income, if you're still in the accumulation phase, reinvest it, buy more shares. Automatically, through a dividend reinvestment plan, a DRIP. Because when you reinvest dividends, you're buying more shares, and those shares generate more dividends, which you reinvest to buy even more shares. It's compounding on top of compounding. And over time, that makes a huge difference. Let me give you an example. Let's say you invest $10,000 in a stock that yields 3% and grows that dividend by 7% a year. If you just collect the dividends and spend them, after 30 years you'll have collected about $35,000 in dividends, plus your original $10,000 investment, which has probably grown too. But if you reinvest those dividends, after 30 years you might have $100,000 or more. That's a huge difference, all from just reinvesting the dividends instead of spending them. So if you don't need the income, reinvest, let it compound, let the snowball roll. That's how you build serious wealth over time. Not by trading in and out of stocks, not by chasing hot tips, but by buying great businesses, holding them, and reinvesting the dividends. It's boring, it's not exciting, but it works. What about diversification now? Some people might say, Warren, 5 stocks, that's not very diversified. And, yeah, that's fair. 5 stocks is not a fully diversified portfolio. But here's the thing. These 5 stocks are in different industries. You've got beverages, healthcare, consumer staples, energy, and payments. So there's some diversification there. Not perfect, but some. And honestly, I don't think you need to own 50 stocks or 100 stocks. That's too many. You can't possibly know all those businesses well enough. I'd rather own 5 or 10 great businesses that I really understand than 50 businesses I know nothing about. Quality over quantity, that's always been my philosophy. Now, if you're more comfortable with broader diversification, that's fine. You can add more stocks, or you can own an index fund alongside these individual stocks. The point is, these 5 stocks, Coca-Cola, J&J, P&G, Chevron, Visa, they're solid. They're the kind of stocks that should be in any long-term dividend portfolio. And if you own them, hold them, and reinvest the dividends, you're going to do just fine. The mental game of long-term investing, well, here's the hardest part about this strategy, and it's not the stock picking, it's not the math, it's the mental game. See, when you buy a stock intending to hold it forever, you're going to see it go down sometimes, maybe a lot. The stock market crashes, the economy goes into recession, your stocks drop 20%, 30%, maybe 50%, and you're going to feel scared, nervous, like you should sell. But that's exactly when you shouldn't sell. Because if the business is still good, if Coca-Cola is still selling Coke, if P&G is still selling Tide, then nothing has fundamentally changed. The stock price is down, but the business is fine. And over time, the stock price will come back because the business is still generating cash, still paying dividends, still doing what it does. I've lived through I don't know how many market crashes at this point, 10, 15, and every single time people panic. They sell. They think, this time is different, this is the end. But it never is. The market always recovers, always. So the key is to stay calm. Don't panic. Don't sell just because the stock price is down. If anything, buy more, because you're getting a good business at a discount. That's what I did in 2008, 2009. When everyone else was panicking, I was buying. Because the businesses were the same. The prices were just lower. And that turned out pretty well. So that's the mental game. Staying calm, staying focused on the long term, not getting caught up in the short-term noise. Because if you can do that, if you can hold through the ups and downs, you're going to be rewarded. The dividends will keep coming, the businesses will keep growing, and your wealth will keep compounding. That's the game. That's how you win. My personal philosophy. You know, people ask me all the time about my investment philosophy. What's the secret? What's the magic formula? And the truth is, there is no magic formula. There's no secret. It's just common sense, discipline, patience. Buy good businesses at fair prices, hold them for a long time, let them compound. That's it. That's the whole thing. Now, finding those good businesses, that takes work. You've got to read. You've got to understand the industry, the competitive landscape, the financials. But once you find them, the rest is easy. Or at least it should be. Just hold. Don't get cute. Don't try to time the market. Don't overthink it. Because the more you trade, the more you tinker, the more you try to be clever, the worse you tend to do. I've seen it over and over again. The people who do best are the ones who buy good stocks and just sit on them. The people who do worst are the ones who are constantly buying and selling, chasing the next hot thing, trying to outsmart everyone else. So be patient, be disciplined, be boring, because boring works. Boring gets you rich over time. And these 5 dividend stocks, Coca-Cola, Johnson & Johnson, Procter & Gamble, Chevron, Visa, they're boring. They're not exciting. They're not going to double overnight. But over 10, 20, 30 years, they're going to compound. They're going to pay you dividends. They're going to build your wealth. And that's what matters. Well, I think I've said just about everything I wanted to say about dividend stocks. Let me just leave you with this. If you're looking for stocks to buy and hold forever, stocks that'll pay you reliable dividends, stocks that'll help you build wealth over time, these 5 are a great place to start. Coca-Cola, Johnson & Johnson, Procter & Gamble, Chevron, Visa. 5 great businesses, 5 dividend payers. 5 stocks you can sleep well at night owning. Now, I'm not saying these are the only stocks you should own. There are lots of other great dividend stocks out there. But these 5, they've stood the test of time. They've paid dividends through thick and thin, and I believe they'll keep doing it. So if you buy them, hold them. Let the dividends reinvest. Let time do its work. And in 20, 30 years, you're going to look back and be very glad you did. Because dividend investing, it's not flashy, it's not exciting, but it works. It's worked for me. It's worked for millions of other investors, and it'll work for you too. So thank you for listening to an old man talk about stocks for a while. I hope this was helpful. And remember, invest wisely, be patient, and let those dividends compound. Take care.